Hey everyone, welcome back to Corporate Decoder. Today we're diving into a financial filing, a 10K report that's like a company's year-end tell-all. Now, this one's a bit like opening a fortune cookie and finding out your financial future might depend on, well, how much money you can borrow. It's OFS Capital Corporation's report, so buckle up because we're about to decode it. OFS Capital, in a nutshell, makes money by lending to and investing in other companies. They aim to give their shareholders both steady income and the chance for growth. But like any good story, there's more than meets the eye, so let's get into it. First off, we're told that they need to invest in specific types of assets, qualifying assets, to keep their status as a BDC, a business development company. It's like a club with rules. About 80% of their investments need to fit this category. The rest, well, that's their playground for riskier, more opportunistic investments. Speaking of rules, they have to maintain a certain asset coverage ratio. Think of it as not being allowed to borrow too much compared to what they own. They've gotten approval to lower this ratio, which means they can borrow more. It's a double-edged sword. More borrowing can lead to bigger gains, but also bigger losses. It also depends on approval from the board of directors. Their investment activities are managed by OFS Advisor, and this advisor gets paid a management fee based on how many assets OFS Capital has, plus an incentive fee based on how well those assets perform. This can create a conflict of interest, pushing the advisor to take bigger risks to boost their own payout. OFS Capital primarily targets middle-market companies, which they define as companies with revenues of $15 million to $300 million and with EBITDA from $5 to $50 million. They find this market attractive due to high demand for capital, but of course, they face competition from other lenders and investment firms. Their investment process focuses on primary drivers, industry overview, and enterprise valuation. OFS Advisor has a committee that evaluates and approves these lending opportunities and monitors the investments. They even have an internal risk rating system, which is like a report card for their investments ranging from low risk to loss, which is not where you want to be. This rating system helps them keep an eye on their investments. Now let's talk about how OFS Advisor gets paid, because that's always interesting. They get a base management fee, which is a percentage of the total assets, regardless of performance. Then there's an incentive fee based on how well the investments do. This incentive fee has two parts, one based on income and another based on capital gains. This incentivizes the advisor to grow the total assets in size and to be strategic in their investment decisions. They also have an agreement with OFS Services, which handles all the administrative tasks. It's not free but allocated based on resources used. The company is allowed to co-invest in their existing portfolio companies to a certain extent, subject to certain conditions. The company must comply with many things to keep their status as a RIC for tax purposes and the excise tax of 4%. There are risks related to economic, market, and other instabilities that can affect its business. There was a recent announcement that Jeffrey A. Cerny will resign as Chief Financial Officer, effective end of March. This may also trigger a risk. Also, the document mentions cybersecurity risks which may affect their business. These risks may materialize, and it may be possible to fully be prepared for everything. OFS Capital also operates as a non-diversified management investment company. It is therefore not limited by the 1940 Act with respect to the proportion of its assets that may be invested in securities of a single issuer. This can also be a risk. The report clarifies that OFS is not a shell company. Checking out how the stock has performed, and the NAV or net asset value, which in simple terms is the price at which the company's assets would fetch if liquidated, is required as part of these reports. To understand all these fees, here is a hypothetical example. The calculations in the table below are hypothetical, and actual returns may be higher or lower than those appearing in the table below. Now, what do I think about all this? Putting on my corporate decoder hat, OFS Capital is walking a tightrope. On one hand, they're trying to generate income and growth for their investors. On the other, they're dealing with increased debt and complex relationships with their advisor. They have a base to build upon, but it's easy to notice that they are exposed to market instability. They will also need to prove that they can perform under the new financial lead. Also, it's my opinion their reliance on unobservable measures is risky for a potential investor. There are obvious risks in these types of securities, and if anything goes wrong, the company has a few hurdles to face. So, is OFS capital a good investment? It really depends on your risk tolerance. If you're comfortable with a bit of uncertainty and trust their ability to navigate these challenges, it could be an interesting opportunity. But as always, do your own research and talk to a financial advisor before making any decisions. Thanks for watching. If you found this breakdown helpful, hit that like button, drop a comment with your thoughts, and subscribe for more corporate decodings.